In 2020, remote work broke the housing market. Prices in small cities exploded. Affordable towns stopped being affordable. Millions of people moved. Millions more got priced out. Then, starting in 2022, the companies started calling people back. Return to office, 3 days a week, then 4, then 5. And everyone assumed the same thing. If remote work drove prices up, returning to the office would bring them back down. It didn't. And the reason why reveals something most people fundamentally misunderstand about how housing prices work. Prices move through a one-way door. They go up fast. They come down slowly, partially, and only under extreme pressure. And they almost never return to where they started. That's not a market failure. That's the market working exactly as designed. Think about what happened to Austin, Texas. In January 2020, the median home price was around $299,000. By May 2022, it hit $538,000. That's an 80% increase in 2 years. Then the Federal Reserve raised interest rates. Companies started mandating office returns. The remote work wave began to recede, and prices fell. They fell for 2.5 years. By early 2025, Austin's median price had dropped to around $440,000, a correction of nearly 20% from the peak. That sounds significant. But here's the number nobody leads with. The monthly mortgage payment on that $440,000 house in 2025 at current interest rates is roughly $3,450. In 2019, a $299,000 Austin home cost about $1,950 a month. The price came down. The cost went up. Compared to before any of this happened, Austin is still 77% more expensive to actually live in. The correction corrected nothing. Here is the mechanism behind that number. Housing prices move through two completely different systems, depending on the direction they're traveling. When prices rise, they're driven by demand, and demand can move fast. A policy change, a viral article, a wave of migration, a shift in interest rates. Demand is liquid. It moves overnight. But when prices fall, they're constrained by supply, and supply moves slowly, grudgingly, and often not at all. Sellers don't have to sell. Homeowners don't mark their asset down to reflect a changed market. They wait. They hold. They rent it out instead. They turn the spare bedroom into an Airbnb. They take the listing down and revisit it in spring. Meanwhile, the buyer who needs a place to live doesn't have that kind of time. Economists call this price stickiness. Prices are sticky downward, meaning they resist falling even when every rational signal says they should. It's asymmetric by design. Sellers are not forced to act. Buyers often are, and the result is a ratchet. Each shock upward becomes a permanent new floor. The door swings open going up. Coming back the other way, it barely moves. To see how this plays out in a real life, meet Liam. In 2019, Liam was 33 years old, a software engineer at a mid-sized tech company in San Francisco. He earned $125,000 a year. His rent was $3,100 a month for a one-bedroom apartment. He was saving slowly. A house felt distant, but possible. Then the pandemic hit, and his company went fully remote. Liam moved to Boise, Idaho in early 2021. The median home price there was around $380,000, half of what a comparable home cost in the Bay Area. He bought a house. For the first time in his adult life, he felt financially stable. 2 years later, his company issued a return-to-office mandate. 3 days a week, minimum, at the San Francisco headquarters. Liam couldn't commute from Boise. He had a choice: sell and move back, or find a new job. He found a new job, remote, with a different company. But his colleagues who didn't have that option, they moved back. And here's what happened to their cities on both ends. San Francisco's office vacancy rate had hit 36.9% by end of 2024. Despite the return-to-office push, barely a fraction had been reclaimed. The city had lost billions in commercial property tax revenue. Services were being cut. And yet, home prices in San Francisco were not back to 2019 levels. They had stabilized, even ticked upward in some neighborhoods. Meanwhile, in Boise, prices peaked, fell somewhat, and then stopped falling. By 2025, the median was still nearly 50% higher than in 2019. The people who had been priced out during the boom, the teachers, the nurses, the longtime residents, they hadn't come back. There was no correction for them. The door didn't open from the other side. The first hidden rule is this: housing prices and housing costs are not the same thing. And in the post-pandemic correction, costs went up even as prices came down. Here is why. When remote work flooded cheap markets with demand, prices rose fast. Then the Federal Reserve, trying to fight inflation, raised interest rates sharply, from near zero in 2021 to over 7% by late 2023. Higher rates were supposed to cool prices, and they did, slightly. But higher rates also dramatically increased the cost of a mortgage, so the price came down 15 or 20% in some markets. But the monthly payment went up, because the rate had more than tripled. In Austin, the math looks like this. 2019, median price $299,000, rate around 3.7%. Monthly payment, roughly $1,950. 2025, median price $440,000, rate around 6.8%. Monthly payment, roughly $3,450. A lower price, a higher cost. The people who bought at the 2022 peak are underwater on paper. The people who waited for the correction are paying more per month than they would have in 2019. And the people who were priced out in 2021, they're still priced out. The correction fixed nothing for them. It just changed which group of people was being squeezed. The second hidden rule goes deeper. Return to office didn't just fail to reverse housing prices. In many cities, it made the problem worse in a completely unexpected way. Think about what happens when a company mandates office return in San Francisco. Employees who had moved to cheaper cities now face a choice. Some move back, but they're moving back into a city where office vacancies are at historic highs, where commercial landlords are desperate, where city tax revenues are collapsing. San Francisco's office vacancy hit 36.9% in 2024. Before the pandemic, it was around 5%. That's not a correction, that's a different city. The return-to-office push didn't fill those buildings. Leasing activity picked up somewhat in 2025, driven not by companies returning workers, but by AI startups backfilling space that old tenants left empty. It created a strange new pressure, a city simultaneously losing its economic identity and trying to reclaim it through a completely different industry. The tech workers who zoomed out are different people from the AI researchers zooming in. The neighborhoods they live in are different. The rents they pay are different. The businesses that served the old workforce are gone. And here is the counterintuitive result. In San Francisco, the return of some workers created pressure to convert empty office buildings into housing, which means the very buildings that remote work emptied may soon house the people that remote work displaced. The city was restructured by a single policy decision made in corporate boardrooms, and then partially restructured again by the reversal of that same decision. Neither time did anyone ask the people who lived there first. Now let's name the full architecture. Remote work didn't create the housing affordability crisis. It revealed the mechanism underneath it. The mechanism is this: housing in America is both a home and an asset, and those two functions are in direct conflict. As a home, you want prices to be affordable and stable. As an asset, you want prices to rise and never fall. The United States has spent 50 years designing policy that favors the asset function over the home function. Zoning laws that restrict supply, keeping values artificially high. Tax codes that reward ownership and penalize renting. A Federal Reserve that cuts rates when home prices fall and raises them only when inflation gets out of control. The mortgage interest deduction, which subsidizes buyers over renters. Capital gains exclusions on home sales, which make housing more attractive as an investment than a residence. Each of these creates upward pressure on prices. None of them creates meaningful downward pressure. The result is the ratchet. Remote work in 2020 was an extreme demand shock. It pushed prices up farther and faster than almost any event in modern American housing history. The National Bureau of Economic Research found it was responsible for more than 60% of total U.S. home price growth between 2019 and 2021. Then the shock reversed. Rates rose. Companies called workers back. Demand softened. But the ratchet held. Austin didn't go back to $299,000. Boise didn't go back to $230,000. The new floor was set, and it was set above where most people could afford to live. Here is what this reveals about who the housing market is actually designed to serve. When prices rise sharply, one group benefits: people who already own property. When prices fall, even partially, that same group resists. They hold their property. They wait. They lobby against zoning changes that would increase supply. They vote against new construction in their neighborhood. They file legal challenges against apartment buildings. They attend city council meetings at 2 p.m. on a Tuesday because they can afford to. The result is a system that transfers wealth in one direction, toward owners, and then makes that transfer permanent. There's a data point that captures this better than any other. In 2019, Austin was considered a booming but still somewhat affordable Texas city. By 2025, even after 2.5 years of price correction, the monthly cost of owning a median-priced home consumed 38% of median household income. The traditional affordability threshold is 30%. Austin is still unaffordable, not despite the correction, but in part because of the interest rate response to it. The correction punished buyers. The owners who bought before 2020 or sold at the peak in 2022 extracted enormous wealth. The people who tried to time the correction, who waited for prices to come down before buying, are paying more per month than they would have in 2019 at the old price. Remote work gave people a momentary window. The window closed, and it closed faster than anyone could move through it. There's a question worth sitting with. If remote work raised prices and return to office didn't lower them, then what, exactly, is the mechanism that brings housing back to affordability? History suggests almost nothing. National home prices have fallen in only one sustained period since World War II, between 2006 and 2012, during the worst financial crisis in a generation. And even then, they recovered within a decade and surpassed their previous highs. The ratchet reset, and then it kept going. Here is what the remote work experiment actually proved. It proved that housing prices don't follow supply and demand in the clean, symmetrical way that economics textbooks describe. They follow power, the power to hold, the power to wait, the power to absorb a loss for years until the market turns. That power belongs to owners, not renters, not first-time buyers, not the people who were priced out. Liam still lives in Boise. His company stayed remote, but he knows the people who moved in next door paid $180,000 more than he did for the same floor plan. And the teacher who grew up 3 streets over is now renting a room from her parents. She had a plan. She waited for the correction. The correction came. And still, she can't afford to buy. This is the hidden rule that remote work made visible. The housing market doesn't respond symmetrically to shocks. It absorbs upward pressure and holds it. It resists downward pressure and finds reasons to stop. The door is one way, and the people who needed prices to fall the most, the people who were waiting outside the door, are still waiting. The market didn't fail them. It worked exactly as it was built to work, for someone else.